Today I am going to discuss about the bond price. How can we price a bond? In the last lecture, we discussed about the equity valuation, and we used the discounting method to arrive at the price of a equity stock. Same method of discounting the cash flows can also be used for valuation of bond prices. Just for recapitulation, you can recall that bond is a fixed income long-term security. So it means that it has got a coupon rate, a face value, and a maturity period. It means that bond is sold at certain price, let us say 1,000 rupees. It carries certain rate of interest, let us say that 12 or 10%, and it has got a maturity period that bond will be retired or will be redeemed after, let us say, 10 years. So we can picture this inflows and outflows in this way, that it comes 10th year, then the 10% of this is 100 plus finally the coupon will, so every year we will receive 100, 100, 100 till the 10th year, and finally it will be redeemed by the issuers. It may be a corporation, it may be government, or maybe any other body. So this is the feature of a typical bond. Now what happens that during the life of this bond of 10 years, the bond price may fluctuate. For example, the face value, because there is a secondary market as well. And moreover, even if there is no active secondary market, the rate of interest fluctuates. When rate of interest fluctuates, what happens is that the price of bond may be affected. Just to tell you that if the rate of interest for similar kind of bond which has got the similar features in terms of risk and all rating, let us say, carries a rate of interest of 12%, and if you buy a similar kind of bond now, you will get 12% rate, whereas this bond is providing only 10%. So actually its price should go down, and that is why during the life of the bond its price at which it may vary. But please remember one thing, that a bond price may vary during the life, but when the time of maturity comes, then the price at which it will be redeemed will be the face value. Please forget the various permutation which may have been taught in the first year, like a bond is issued at par, redeemed at premium, bond is issued at premium and redeemed at this. And like a bond may be issued at a discount and redeemed at the face value for the zero coupon bond. But other permutation combination have nothing to do with this thing. So with this background, now you can picture the cash flows. This is the cash outflow, and these are the inflows in the form of rate and interest inflows, cash inflows. So we have to, since the benefit will be received in future, therefore we have to discount it, kind of time travel which I told you. We have to discount it, that if we are paying 1,000 now, whether it will be worth taking or not. If the present value of this is, the NPV is positive or is just equal, then we are zero, then we can say that it is worth investing. So we have to value the present value, that 100 rupees received for these 10 years, plus the final, 1,000 rupees which is received after for the face value in the final. So 10 annual coupon payment plus the final payment. So this is, with this background, this formula can be, you can have a look, that we have to find out the value of the bond by discounting the coupon, that is the rate of interest, by a rate of interest discounting factor and the par value. So if there are 100 coupon rate is there, time period is 10. So for every year, so we have to discount it by the and the final. So we have to. So let us take an example. So same thing has been explained in this way, price of a bond and the number of period to maturity. And if it is a semi-annual, please keep in mind, if it is semi-annual, then the this will be divided, rate of interest will be divided by this, but we'll take annual. So same thing has been explained here. Let us take an example to understand this. Now consider a 10-year 12% coupon bond. It pays, let us say, 10 year. This is the 10th year. 12%. Face value is 1,000. 12% means that 120, 120, 120, and finally 120, the last coupon payment, plus 1,000 rupees. So we have to find out the present value of these cash flows that can receive, whereas it results in the cash outflow of. Now, please remember that this is what I told you just now, that coupon payment will be to 120, 120, 120 each year. But the required rate of this bond is 13%. Why 13%? Because the similar kind of bond may be providing the rate of interest of 13%. Therefore, if we want to find out what is the value of this bond, then we have to use this discounting factor. So that is why 120 will be the, so will be discounting by 13%. And we have just taken the 120 each year and finally. So what we will do that we will look in the present value table, and I think that in the first year you may have done it. So we can find out the present value, or we can use the same formula, present, like it is discounting factor, 1 plus 130. If you take, the discounting factor, so we can find out. So present value of this is 0.5426, and then the final payment of present value of this is 0.295, and therefore if we multiply by this the present value, so it is come out to be 946, whereas the face value of the bond is 1,000 rupees. So this bond is being sold at a lower than this, being the price at a discount. Now, why this has happened? Because the required rate of return interest is higher, 13%, than the coupon rate. If it was lower, for example, it was 11%, then the value of bond would have been more than 1,000. So it would have been at a premium. That is why rate of interest and the price of bonds are inversely related. If the rate of interest goes up, price of bond will go down. So inversely related, and that is why this is happening. And I assume that you have already studied present value and all that in the financial management. If not, then can be taken up, but I advise you that please go through the present value concept, tables and all that. If you have not gone through, then go through, and if there is any issue with that, I will take up. Okay. Now, this is what I was explaining. That the price and the bond and the let us say yield here, just assume that it is the rate of interest. Okay. for the moment, other the technical difference. So if the rate of interest is lower, let us say bond price will be high, and like 13% prevailing interest rate has brought down the value of the bond below the face value. And this is what happens here. For example, the bond carried a rate of, for example, 13% is of a bond is the, if par value of a bond is 13%, just assume that the bond provide 13% rate. If rate of interest prevailing that a discounting factor is 11%, bond will be sold at a premium. It is more than, it is less than the rate of interest. If bond, the required rate of return is 15%, the bond will be, bought, sold in the market, and the value of the bond will be at discount than the face value. But at the time of maturity, for example, this 8-year bond is there. So at the time of maturity, you see that there is a convergence. Finally, the bond will be redeemed at the face value, 1,000 by the issuer. Whatever may happen, that in the during the life of the bond may be the price of bond may be at premium in the face value, or it may be lower than the face value, depending upon the rate of interest. But at the time of maturity, the bond price will converge that 0 year when it will be redeemed. So it will be, it will be at the face value. So that is why the price of bond may vary because of the variation in rate of interest in the market. Now there is one more concept in related to the bond. This is that it has been asked that what is the present value of the bond, like what is the price of equity. The valuation of bond are much easier than the valuation of equity, because we know with certainty the stream of cash flows which we will receive. Whereas we are talking, when we are valuing equity stock, we are just keeping in expected dividend or like that. So I think that you have studied a concept of IRR, internal rate of return capital budgeting. Internal rate of return. IRR in capital budgeting concept. There are various methods of capital budgeting. Like, simplest method is payback method, NPV, and this IRR, So what is done in IRR, that the cash outflow is there, that your project is there, and then there are inflows over certain period of time, 1, 2, 3, 4, 5. Here cash flows and inflows are given and asked to find out the rate that it will equate the present value of these cash inflows with the cash outflow. In earlier case, the rate was given that you have to discount by this rate. Here rate is not given. So you have to find out the rate R. So there it was given that you are asked to find out the price, because other factors were given. So here what happens is that you have to find out the rate with that will equate it. And the procedure is same like in capital budgeting of IRR. Only thing is that we have to cast these cash flows in terms of the bond. And bond, that there are certain coupon rate. If you assume that these are the interest payment of bond, and there is a par value of bond which will be redeemed after the expiry of the period or the period of the. So it is really, so this is in the bond terminology is known as YTM, yield to maturity. What rate will equate the present value of cash flows to the outflows? Let us take an example. Consider a rupees 1,000 par value bond carrying a coupon rate of 9%. Meaning 9% is the, what is the situation now? 1,000 Coupon rate is 9%, 90 rupees, 90 rupees, 90 rupees per period is 8 years. 8 years. So after 8 years, saving, let us say 90 plus 1000. Okay. So these are these. The bond is currently selling for rupees 800. The present value of bond is 800. Now just I will tell you one thing. By looking at this thing, you can guess that if the bond is being sold at discount, the rate of interest will be higher than this. The rate of interest which is required will be higher. So naturally, it will be more than 100. Or if it was 1100, by looking at this thing, well, just an idea, it will be more than it will be more than 9%. Because if it is, because this R will be, if you in denominator, if R is, the discounting factor is higher, then naturally the numerator will be lower, and therefore it will, and also the relationship is there. So let us try to, so this is how the cash flows will play out, so you can understand. It is given here that you have to find out what is, here price is given. If you put the formula here, in this formula, it is given 800 is the current price, coupon rate is 90 rupees for 8 years, and 1000 will be the par value. So up to T number of years, that is 8. This is situation. You are asked to find out this R. This is not given. So one question why this it is that since we do not know R, then we take a trial and error method. For example, we try to discount by, let us say, 13%. Here, instead of putting C here, 13%, 1 plus 3, 1, and like this, in number of year 8. So we try to discount it by this 13% and see what is the value of the bond. It's 800. It is again higher than the prevailing market price, 800. Then we try a lower rate. Let us see a higher rate. Because this is bringing out a value, so we will try a higher number here, 114, because if it is higher, then naturally this will become lower, each of these. Now it seems that the value of bond lies between 13% and 14%. We do not know exactly, so we extrapolate this thing, and there is a method which you may have done it in the first year, that the difference between these two, for example, the bond value is 808 minus 8. That is the price of the prevailing price, and then we subtract this difference which we have arrived at. In this way, what happens that by using this thing, we get a rate which is 13.2%, and this is the rate that will equate the present value of cash flows like. So this is a trial and error method which is carried out by finding a price which is higher and finding a price which is lower. So if you find a price higher, you try higher rate of interest. For the 13% is 808 as a price. So therefore, a higher rate of interest is applied. So this is given. So in this way, we arrive at 13. But there is also an approximate formula. This formula can also provide, and the rates very similar to this. And this formula is that the coupon rate plus the maturity price plus the present value, the price prevailing now, divided by the n number of years, 8, and then because this is a derivation from a formula, So this is the final result. If you put these values here, you can also get this number almost approximately. That is why this is approximately equal. For instance, if we bring this formula here, the formula is, so what is given, the coupon rate plus the maturity value, the present value divided by n, and this is 0.4 into the maturity value of security plus 0.6 into the present value, the prevailing price now. So this is, you have got coupon rate which is 90 rupees every year, and then maturity value of is 1000, present value of bond is 800, and other factors are given. Number of years is n is 8. So we have put these values here. So by this we are getting a number which is 13.1, which is very close to 13.2%. By this method you are getting a number which is 13.1. Otherwise, by extrapolating the number, we can use the higher number and lower number, and then number will. It is like, that you may have done in arithmetic, that difference is this much, then this is this. The same method has been used in trial and error method. This also gives us. So this is IRR. At this rate, the cash flows and outflows will be equal because R is not given, and in this way we have arrived at. So this is an approximate formula which is used, but in that the Excel and other, these are facilities are there, which we will see later on. How can we do that? So this is also another important concept because that in financial press, YTM is of various bond, the YTM is indicated, and that is why yield to maturity is a very important concept. The various bonds may be there, so it is quoted there. So there is so the difference. There are one more thing which related to the bond which I would like to discuss with current yield, but let us recapitulate what I said. YTM is the bond's internal rate of return, is the interest that makes the present value equal to its price. Assume that all coupon are nil. This is assumption. Then there is one more concept, current yield. Current yield, the bond's annual coupon divided by the bond price. For example, the 90 rupees and the price of bond is 800. Okay, so that will provide us that how much we are. For bond selling at a premium, coupon rate will be greater than the current yield or greater than YTM. This is a theorem, the relationship part. This formula to go back further. This is the what I did. If coupon rate, annual coupon rate is, let us say, 130, and price of the bond is 800 current bond, then that will give up the yield, how much we are getting. Now, as I told you, that yield curve is very important because that there are securities. Some are short term, some are long term. And that is why this also tells us about the expectation of interest rate. For instance, various examples are given that if maturity is 1, 2, 3, 4, 5, 6 years, the current price need. So if we depict on a graph the number of years, so it may look like this, Similarly, we can have various, for example, if you look temp mean the period, because a bond may be for 10 years, 15 years. So market's expectation about interest rate fluctuation is captured by yield to maturity. For instance, if you find an upward sloping yield curve, it means that market expects rate of interest to go up, but beyond that it will become, the plateau type, it will not, like in this, the prevailing interest rate may be high, but later on at the long haul, the rate of interest, the yield to maturity may go. Flat means that if you find it, then it means that the rate of interest will not change for a period of time. Hum means that in the beginning it may increase and then decrease and then likely. So YTM is very important because of the market's expectation. And you know that rate of interest is affected by so many factors. Rate of interest is rate of inflation is there, and other factors are there. How the government respond, say monetary policy response in relation to that, and so many factors they affect the exchange, the interest rate. So that is why YTM in the fixed income securities market is an indicator of the expectation of the market about the rate of interest. Now, this bond calculation is simple, but bonds are also risky. You know that there are certain risks involved in the bond also. For instance, the market interest rate is there because the prevailing market interest may affect the price of the bond. As I told you, that higher the interest rate prevailing in the market, lower will be the value of the bond. Rate of interest goes up, the value of the bond may go down. So there is a market risk involved. Another risk is involved is the reinvestment risk. That interest rate on interim cash flows. That if you receive interim, if you are now for example, you invested at a high rate of interest, and the prevailing interest rate is now 10%. You receive a cash flow, let us say interim, 1 year, 2 year, 3 year, and you reinvest it, you will end up investing at a lower interest rate. So reinvestment, it may be other way around also. It may be higher, so one can. Then bonds are fixed interest obligation. Therefore, the issuer may default, what we call credit risk, may not pay the rate of interest on time. So it may also default. Then there is another kind of risk which we call purchasing power risk, because the interest and inflations are related by, as I've already discussed with you, the Fisher effect. So when inflation goes up, it also may pull up. Not one-to-one, but there is. So if the rate of interest at the time of issuance of the bond, rate of inflation was 10%, let us say bond interest coupon rate was 12%, so real was, let us say, 2%, inflation minus rate of interest. Now, if the rate of the inflation increases, and let us say goes to 13%, and rate of interest is 12%, then in real term it will be -1. So that is why the fixed, this purchasing power, the inflation, high inflation may also affect it. Then exchange rate risk, I've already explained to you that if one has made investment globally, then exchange rate fluctuations may also affect it. So that is why if you are getting, for example, US and India, somebody has made investment is 2%, in India is 12% rate of interest, so difference is 10%. That is why the money flows in India to take advantage of this high interest rate. But it may happen that by the time this rupee is converted into dollar, rupee may decline in value and it depreciate. Let us say rupee may depreciate by 10%, so then the result will be zero in a real terms. The whatever gain you have got has been nullified by the adverse exchange rate movement. So that is why it is also very important. Then in market also, there is a risk involved of liquidity risk. Liquidity means that when the buying and selling of it can be cut at the transaction cost for that is low. Not that if you are going to sell it and then the price it should fetch is 900 and you end up getting 850. And sometimes it happens that in market is there is liquidity has dried and therefore the secondary market may not be. For example, in India, one of the issues in government bonds is that there is not very active secondary market for government bond. That is why the investors are mostly the captive players, not the general public. So liquidity plays very important. Sometimes that Bonds are bought and because there is so much risk involved, like the default is there, economy-wide recession is there. So one end up getting a lower price, and various other events may affect the bond, like for example, natural, you know it very well, no need to tell. Similarly, sometimes corporate restructuring takes place. Corporate restructuring, maybe a mergers is there, or takeover or divestiture is there. So that also affects the. So that is why bond investment is not fully risk free. It also affected, but as I said, that it provides a short return in terms of the but that is why the this, for example, to arrive this risk, but this is rating is based on the capital structure of a company, various based on various financial statement analysis, how much is debt, how much is the liquidity position of the company, and so on and so forth. Rating is done. And in India, for example, CRISIL is one of the leading that provide that what is the risk involved in the if you make investment. That is why rating agencies are there. So they try to assess the probability of interest payment and principally sometimes nations default, like Sri Lanka recently reported that it may default in payment. Latin American countries, they have defaulted in interest payment because it entails a fixed obligation, whereas equity does not entail a fixed obligation. If a company is making loss, though the shareholders will be paid nothing, and then that can be absorbed. So it recommends that there are various kind of rating, AAA, and this, and based on these parameters. So in order to arrive at this thing, elaborate industry, business, and financial analysis of the company are undertaken, and there are models as well. Like various models are there, like Altman's Z-score model that takes account the current ratio, capital structure, and so on and so forth. So that can tell us about that. But there are the various kind of model of credit rating risk is done by these rating agencies. So I will not go in that detail. I will provide some material you can read. With this, I have briefly covered, and one more thing I would like to. Sometimes these rating agencies, they are to play an important role. For example, if some security is called safety standard AAA, or let us say downgrade, let us say the lowest one. Just as an example, I'm not going to. So it is below investment grade. So what they put a stamp here. In stamp means that they endorse that this is in terms of credit worthiness, it is high. But these rating agencies, they sometimes they may have their own vested interest. In financial crisis, what happened that some securities which were very risky, these rating agencies, they provide highest rating to them because they get a commission. Like sales agent, they get a commission. When, for example, 1 million worth securities, they get a commission on that. So they put a stamp or approval, and there were one of the major culprits also behind the default of mortgage-backed securities and other was the rating agencies, which they made a huge amount of money through commissions, and that brought the disaster. So their role is also very important in so that is why the. So with this, I have covered the briefly some salient aspect. I am not saying that I have covered all the aspects because that is not possible for me at this juncture. Because time is very short also, like duration, immunity, and all that. I have convexity and all that. I'm not taking up right now. But I think that if you go through these things, then you can. Now, after this, I also plan to introduce to you a very important concept which acts as a foundation for the financial, the various asset pricing model and all that. That concept is known as market efficiency. You know that market efficiency is one of the most important concepts in finance. Like the models we have discussed about CAPM and other models. The foundation of these models is based on image. So I will explain to you what we mean by an efficient market and how this efficient market provides the foundation for the, if market is not efficient, security price will not be correctly priced. They may be overpriced. If market is not functioning well, bubble may be created. Price may deviate from the rational values like that. So let us take a definition of efficient market. The inefficient market is defined as where prices reflects all relevant information. Relevant information to the securities. What may be relevant information? It may be company related information. It may be economy related information like monetary policy, GDP. It may be industry related information. Maybe some new competitors have entered. So, or other type, because information affects the information, because that whenever you are making investment, all these events are going to affect the security prices. Therefore, whenever a new information comes in the market, share prices react to that. Because of that, it may go up, down, or may like this, So if you take the time, release of information, if you just watch the budget is being announced and they see the share price reaction, if some person has, on social media has just made a statement, if RBI governor has announced monetary policy or just a press release, all these because the market takes into account these so all those relevant information which are quickly absorbed and and then it gets reflected in the share prices. So therefore, for example, if a company is company's information has released that profit has gone down, earning has gone down, therefore the market will react and the share prices will go down because of the future prospects. Or the economy is not doing well, so the overall market will be affected because of that. So all these information gets reflected instantly and without any delay. And behind this is that whenever you are the operating an efficient market, since market reflects all the information, therefore one cannot get abnormal return. By abnormal return means that one cannot get the return which is more than the risk, more than the risk adjusted return. Risk adjusted return will have to be provided. Otherwise, what will happen that investor will not be willing to invest. But abnormally more than that. So this is and in this market there are certain assumptions that in this market people are rational. A large number of investors are there, they are rational and they want to maximize profit and they are actively participating and no individual can affect market price. Investors are not very large, they do not buy large quantities and they affect the price, so they cannot influence the price because of their buying and selling actions. Prices may not give, and all the information is costless and widely disseminated, and investors react quickly and fully to the information. So all these assumptions are there. Number one, rationality, we will see in the last part that this rationality assumption when a market is not dominated, may be dominated by some other type of investors which are not rational, irrational investors, noise traders, and like that. So, but you know that the information gets quickly reflected in these. This is the assumption. And based on this thing, the certain other thing emerges. Number one, stock prices because of this are correct, and no one, as I have already explained, to more than risk adjusted return. Meaning there might be the valuation of the share prices by market in aggregate will reflect the correct valuation. Meaning some maybe plus minus variation may be there. It will not be exactly. You know, stock prices are not like a weighing machine, because they are, you know, they also reflect. So there might be, but by and large they reflect, and there is no free lend that buys using the some history of stock prices other one can. Now EMH has got three versions, three forms. Uh, so let me explain to you. Other things are given in my slide. You can. I will come back to this. One is that market may be efficient in weak form. There are three versions. Weak form, semi-strong form, and this is strong form, which includes weak form efficiency is stock prices reflects all information about historical prices. What happened about the past, about the prices, and they are reflected. And stock prices follow a random walk. Random walk means that you cannot find a pattern by studying the past prices. Walk of a drunkard person is resembles of a random walk. You cannot predict the walk of a drunkard person. So by studying past prices, we cannot predict, we cannot find a pattern. You know, stock prices has no memory. You know, the price, these are stale information that is already reflected in the share prices. So by studying past, history is history. You know, you cannot benefit from that by studying that. Then second form is that prices not only reflect past information but past plus public information. What are the public information? As I have told you, like company related information, interest rate, like macroeconomic level information, in economy level, all these are public information. There is nothing which is secret. So stock prices reflect not the past information but publicly available. And the third level, which is the strongest form, is that stock prices incorporate reflect not past plus public plus private information. Private information may be that some people are privy to certain information, about the company and all that. So that information also gets reflected here. For example, certain high top level managers, they may be, but that is illegal that you act on that. That is illegal. But all the information, apart from this, that is relevant to the company gets reflected. So market may be efficient. It reflects the information. It may be either in weak form, semi-strong form, or strong form. The levels may be there. So we will try to understand that how can we know that whether a market is efficient in weak form, or how the tests are carried out to know it, that how market may be efficient in these forms or not. Now behind this market efficiency, I have been telling you there is a concept of that you cannot profit, you cannot, is a concept of law of arbitrage. Arbitrage, I have already explained to you. Arbitrage is that the process through which it is also called law of one price. If there are in goods market, it reflects if there is a good which is available in one market at 10 rupee, another market 12 rupee, people will buy and will sell here in this market from X to Y. Okay. Or from one place to another place, they will carry. Similarly, in a securities market, if there are two securities which are similar in risk One is providing 10%, another is providing 12%. So it means that this security is providing higher return. People will buy it and push up the price. When they push up the price, then what happens that the returns will go down. This is the return formula. And so that the price converges, the increases and the return becomes, move to equate with the similar security. So this process takes buying under price and selling based on arbitrage. Arbitrage means that riskless or profit opportunities will not be there in the market. Now just read this part before I go further. What I mean by this. This has been taken from analysis of financial. Is description how prices in competitive market respond to new information. The arrival of new information to a competitor, likened to the arrival of lamb chop to a school of the flesh eating the arena, where investors are plausibly enough. The instant the lamb chop hits that water, there is turmoil as the fish devour the meat. They start eating. Very soon the meat is gone, leaving only the worthless bone behind, and the water returns to normal. Similarly, Similarly, when new information reaches a competitive market, there is much turmoil. Investors buy and sell in response to the news, causing prices. Once price adjusts, all that is left of the information is the worthless bone. Any new information comes that is, acted upon by the investors, and because of this, adjustment which takes place in the market, that information, because of that, the share prices will reflect it, and then that information becomes of no use. No amount of gnawing on the bone will yield any more, and no further study of old information will yield any more intelligence. It means that that is already reflected. So this is how the market reacts to that, and like that. So there is also an example that when I said that you cannot get a return which is more than risk adjusted, higher than the risk adjusted return, abnormal return. One cannot get abnormal return by studying risk adjusted return. One has to get, blind throwing dart and newspapers finally could select up that would be just as it. And it has been an experiment has been carried out where a careful portfolio was formed using the theories like Markowitz and all that, and then similar way, like that throwing darts, and one can form a portfolio of securities 15, 20, 30, and then the performance of this portfolio with that was whether it can beat the market, can perform better. It was found that both the portfolios, they cannot beat the market, by. So that is why the efficient market is considered to be the backbone. Let me come to the point. How these are tested in the market. Explained here. Now, as I said, that there are various levels of market efficiency. What we do that when we want to know that whether market is efficient in weak form, we study the past prices. For example, the past prices of a stock may be taken, and then we try to find out the serial correlation of these. Like stock of particular, let us say 1 week is 13, 14, 15. These are weeks, 3, 4, 5. We try to look at the second week's prices related to this week, or this, depending upon the lag. For example, we say that with 1 lag, or if there are 2 lags, then it will be with this 3 lag, previous 3 years. So we try to look at these, get various lags, 1, 2, 3. Price of this is related to 1 week, or 2 week, 3 week, 5 week, right? And we try to look at what is the correlation. Correlation is between two variables, X and Y. When we say serial correlation, it means that the correlation of the variable with itself. So it has been found that it is not significant that we study the price, then we are not able to get garner any profitable the investment more than the risk adjusted. And then we also hold certain filter rules that buy and hold. If prices fall by 5%, sell. If price increase by 5%, buy. Various filter rules are also simply. So the that also has not yielded much, that by using certain rules, can we beat the market and we get higher return? That has not. So this is how we test the random walk and the whether the stock prices follow the efficient. Then for semi-strong form, that share price reflects all the public information. We take some event like a company, let us say, go for dividend announcement. This is the event when dividends announced by the company. We try to look was released. If there is no difference, then it means that the stock prices reflects all the information. For example, before and after there is a difference, then it means that one can use certain event to understand. For example, when dividend is announced, normally share prices falls. So, or a company is going for stock split or bonus issue, or let us say budget announcement or other factors. So we try to look at this. Accounting changes, IPO and all that. This is how we carry out, this is given there. And the third form, what we try to look at, the performance of mutual fund managers, whether they can provide a return higher than mandated by the market. For example, according to CAPM, let us say return on a mutual fund, I let us say, is equal to risk-free rate RM minus RM, then the risk. So what is done is that the return of the mutual funds are taken and the return on the market, and we run a regression, and we find that if the alpha is positive, that is the intercept, it means that the mutual fund and significant that in the mutual fund has provided more return than the market. So by and large, when we carry out this thing, we find that if you take 50 mutual funds, hardly you will find 2 or 3 mutual funds which have provided a higher return than the market. So on an average, mutual fund managers are not able to beat the market. That is why their returns are not more than what Nifty can provide, and like that is why the passive investors. Now, there are several implications of these efficient market. Number one is that there is a school of analysis which is known as technical analysis. They look at the history of past prices and they say that market is for correction, and they say that if you read the history of the prices, you can predict about the future. And they have got the various method by which they detect that when you should buy, when you sell, like that. So according to this thing, technical analysis will not be useful. Fundamental analysis, which we are going to discuss next, may not be that useful. It does not mean that one should not carry out, but if you want to find out securities which can beat the market or can provide higher return than the market, that may not be profitable. So you may think that when it is not useful, then there is no point in carrying out the information. You know that if market efficiency demands that information should be processed, if information is not incorporated, then security price will not reflect that information. So therefore, the analysts and others, they use that information. And moreover, market efficiency as such, as propounded here, These things are given, you can go in my slide. Has not been, supported by full type of, the extreme form of market has not been supported by the various empirical evidence which has surfaced. For example, the like market efficiency, like volatility and other things. What I will do that I will take up these in my next class to start with, and then I will go on to discuss other things about the macroeconomic and other factors. So I close because I think that you should imbibe this information before I. So somebody has requested me to provide the PowerPoint slide. What I'll do that today I'll provide these slides to you so that you can go through.
Thank you very much, sir.